Hi, I'm John Persinos, Editorial Director of Investing Daily, with a video presentation for Monday, March 20. To view our full range of trading services and publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. There's a lot of hysterical chatter in the financial media about black swans and an imminent global financial meltdown due to recent banking sector woes. The failures of Silicon Valley Bank, Signature Bank, and Silverlake Capitol, and liquidity problems with Credit Suisse and First Republic Bank, they've spooked investors. Financial stocks, especially among regional banks, have taken a beating, and the broader stock market has gotten caught in the downdraft. Another shoe dropped Sunday night when the Swiss government announced that Swiss-based banking giant UBS would buy smaller rival Credit Suisse in an effort to stem further turbulence in global banking. Many analysts are invoking memories of the financial crisis of 2008 and the Great Recession that ensued. Do we face another 2008? The answer is no. Or to put it another way, apocalypse, not now. That said, we experienced a volatile week with the S&P 500 and NASDAQ posting gains and the Dow Jones Industrial Average slipping. Take a look at the following chart. It's telling that the tech-heavy NASDAQ jumped 4.4% for the week, a sign that traders expect the Federal Reserve to get less hawkish. Rising interest rates hurt growth stocks, especially high-flying tech shares. Indeed, that's one of the factors that compelled Silicon Valley Bank's customer base to make a rush of withdrawals. Higher interest rates have been causing a cash crunch among the bank's tech clientele. Oil prices fell 13.7% last week as traders increasingly expect a recession that will dampen energy demand. Bond yields slipped amid recessionary fears as well. We're not witnessing 2008 redux. For starters, central banks around the world in recent days have moved quickly and decisively. However, in the period between Bear Stearns collapsing in March 2008 and Lehman Brothers going belly up that September, there was dithering in Washington and on Wall Street. Also, back in 2008, we were grappling with a gargantuan amount of toxic assets, such as subprime mortgage-backed securities. This time around, we're dealing with U.S. Treasuries, the safest assets on the planet. What's more, the loan-to-deposit ratios have more balance, and the banks in question, they're much smaller. Banks also are sitting on a lot more money than they did in 2008. Thanks to Dodd-Frank, the big banks must adhere to capital requirements and stress tests. These guidelines were loosened in 2018, yes, for smaller banks, but they have remained in place for the big boys. According to the key metric of Tier 1 capital, banks are generally in good shape. Tier 1 capital is the core capital held in a bank's reserves that's used to fund business activities for clients. Banks have more cash on hand to handle potential problems. Silicon Valley Bank, Signature, Silvergate, Credit Suisse, First Republic, they all made their own singular missteps. In the case of Silicon Valley Bank, the bank invested in long-term bonds that tumbled in value as interest rates rose. When depositors made a run on the bank, Silicon Valley Bank sold those bonds at a loss in an attempt to cover withdrawals, but fell short. Systemic contagion is highly unlikely, but odds of a recession have increased. Notably, as this chart shows, the U.S. 10-year Treasury note yield is currently well below 3.5%, which represents a big bet by bond traders that a recession is looming. This confluence of events, though, will probably prompt the Fed to capitulate and ease up on tightening. The Federal Reserve Open Market Committee, the FOMC, meets March 21 through 22, and it's expected to hike rates by 0.25%, or perhaps by nothing at all. Goldman Sachs predicted in a recent note that the FOMC would do nothing. History shows that when the Fed pauses, the equity markets benefit. So the smart move now is to keep your eye on your long-term goals and don't get whipsawed by news headlines. And as always, be wary of partisan spin. For example, we're hearing arguments that SVB went bankrupt because of its wokeism and environmental, social, and governance ESG guidelines. That's complete nonsense. There's zero evidence that SVB's stated desire to be a diverse workplace had anything to do with its collapse. Now let's take a look at the week ahead. We face a crucial week of scheduled economic reports. The highlights: existing home sales Tuesday, Fed interest rate decision followed by Fed Chair Jerome Powell's press conference Wednesday, initial jobless claims and new home sales Thursday, durable goods and S&P Global U.S. Services and Manufacturing PMIs Friday. The big news occurs Wednesday, of course. Due to recent instability in the banking sector, the Fed is unlikely to go beyond a 0.25% hike. Is the sky falling? No. And if Powell's remarks on Wednesday are reassuring, we could actually enjoy a relief rally. Look, I wouldn't blame you for being nervous, but I would blame you for running for the hills. There's a way to protect your portfolio and still stay in the game. I turn your attention to our premium trading service, Rapier's Income Accelerator, helmed by my colleague, Robert Rapier. Robert can show you how to reap exponentially more income out of dividend stocks by using his simple, time-proven method. His system works regardless of monetary policy, regulatory missteps, or bank sector shenanigans. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, that's it for now. Thanks so much for watching. And if you have any questions or feedback, please send an email to me at mailbag@investingdaily.com.